Dear classmates and professor, welcome. I'm Chengzhuo Zhang. Today I will present a detailed analysis of Wild Water Sports Inc.'s inventory valuation method, comparing the advantages and disadvantages of LIFO, FIFO, and the weighted average cost method, and providing targeted strategic recommendations. The choice of inventory valuation methods directly impacts a company's financial performance, compliance, and capital management. My analysis will serve as a vital reference for financial decision making. And now, I will begin my presentation. So my presentation comprised 4 sections. First, the exclusive summary outlines the company's current situations, key finding, and strategic recommendation to establish a comprehensive understanding. And second, it examines 3 inventory valuation methods, breaking down their prospective advantages and disadvantages in detail. And third, the quantitative comparisons are conducted to derive the calculation results for operating cost and ending inventory under each method. And finally, the implementation recommendations and specific action plans are proposed, completing the closed loop process from analysis to decision making. And in these sections, I will first clarify the fundamental issues surrounding the wild water sports current use of the LIFO method, then presents the final evaluation conclusions and strategic recommendations, followed by a detailed analysis of the supporting data and methodologies. The LIFO inventory valuation methods currently employed by Wild Water Sports Inc. may align current costs with revenues and yield deferred tax benefits in inflationary environments. But its structural flaws have long outweighed any short-term tax advantages. By recording the earliest inventory costs on the balance sheet, LIFO results in a permanent undervaluation of inventory books value. It also triggers unexpected profit surges during inventory liquidations, passively increases current liabilities, reduces working capital ratios, and distorts the company's actual liquidity positions. And after a comprehensive comparison of three evaluation methods, we recommend that the company adopt FIFO. FIFO ensures that any inventory reflects current replacement cost, enhances balance sheet accuracy, improves the liquidity matrix, and cooperates borrowing capacity, complies with IAS 2 requirements, and eliminates the compliance hurdles for cross-border operations, and provides inventory turnover figures that align with market realities. And the financial impact of the change is clear and predictable. Under FIFO, any inventory will amount to $20,218, showing a 9.6% increase over the original LIFO valuation. And the IRS permits these adjustments to be amortized over 4 years, fully complying with current accounting standards. And after examining the current inventory valuation practice in whale water sports, I will now explain the fundamental principles behind the three inventory valuation methods, analyzing their respective advantages, risks, and the financial implications to provide a clear understanding of the value differences underlying each approach. The last in first out method, LIFO, operates on the principle that newly purchased inventory is recorded at cost first. So this approach offers inherent advantages in inflationary environments. During economic inflation periods, the cost of newly purchased raw material continue to rise. So the LIFO methods reflect this higher current procurement cost in operating expense, aligning the precisely with current sales revenues and some complying with the matching principles. This approach increases operating cost while reducing taxable profit and enabling companies to achieve tax deferral and optimize cash flow, so making highly favored by remanufacturing enterprise and recognized by U.S. accounting standard ASC topic 330. But however, the structural flaws of LIFO cannot be overlooked either. Inventory recorded on the balance sheet always reflects the historical cost at initial purchase. Under prolonged inflation, this consistently leads to an underestimation of inventory book value, masking the true scale of companies' assets. And more importantly, level pose settlement risk. When procurement volume fell below sales volumes, Lone Star low-cost inventory is depleted, causing all costs to suddenly match current revenues, and resulting in artificial profit surges and unexpected one-time tax liabilities that disrupts cash flow planning. And the principle of the first in first out methods is allocated to cost according to this page. The principle of the first in first out FIFO methods is allocated cost according actual purchase sequence. A fixture that effectively addresses the access distortion is inherent in last in first out approach. The FIFO methods ensures that any inventory on the balance sheet directly reflects the last purchase cost, accurately representing the current replacement value of stocks. This not only optimizes working capital levels but also improves liquidity metrics such as the current ratio, thereby enhancing a company's borrowing capacity. And more importantly, International Accounting Standards IAS 2 explicitly prohibits the use of LIFO. Adopting to FIFO eliminates compliance hurdles of cross-border joint ventures and overseas financing, significantly reducing the compliance cost. However, FIFO is not without flaws. During inflationary periods, including early low-cost inventory in sales costs, lower overall expenses, and inflates reported profits, creating phantom profits, unsupported by actual sales volume. Such inflated profits directly increase corporate tax liabilities and generates additional cash outflows, and management must therefore develop robust cash flow strategies to prevent some financial strains that caused by rising replacement costs being masked by paper profit growth. And the weighted average method represents the most balanced choice among the three inventory valuation approaches, with its core advantage lying in two key aspects. Firstly, it calculates a single weight cost by dividing cost by total quantity, aligning this figure with both cost of goods sold and ending inventory levels. This approach mitigates profit fluctuations caused by raw material price volatility and fully complies with current U.S. accounting standards. Secondly, it estimates eliminate it, secondly, it eliminates the need to track inventory cost by batch, significantly reducing accounting workloads while institutionally preventing companies from manipulating the profits through the deliberate year-end adjustments to procure timing, a feature particularly applicable for manufacturing enterprises with complex product lines. And however, the inherent shortcoming of weighted average methods remains significant. During the inflationary periods, this method combines historical cost multipliers with current high price in pricing calculations, resulting in ending inventory books value consistently lagging behind actual market's replacement cost, while sales costs fail to reflect the true current replacement cost. And more critically, the averaging approach occurs genuine production marginal cost, preventing management from obtaining accurate cost data to support dynamic pricing decisions and potentially enjoying corporate profit margin. So next, I will use specific quantitative calculations to visually compare the differences between various methods in estimating operating costs and ending inventory values. As shown in the table, the total inventory cost calculated using all three valuation methods is identical, which is about $61,196. And the only difference lies in how cost of goods sold are allocated to any inventory, which constitutes the fundamental principles of inventory valuation logic. And different accounting methods use distinct quantitative differences. Level allocates a larger portions of cost to goods sold, resulting in a current period cost of $42,754, the highest among the three methods. And the FIFO, on the other hand, retains more cost on balance sheets, yielding an ending inventory value of $20,218, also exceeding the other two approaches. A comparison of the allocation results between LIBOR and FIBOR reveals that FIBOR compared to LIBOR transfer a total of $1,776 in costs from operating expenses to ending inventory. And in addition, I break down the analysis into individual product lines for cross validations to ensure the consistency in methodology. And at the aggregates level, the fiber outperforms other methods by reporting higher ending inventory values. A conclusion fully supported by breakdown data at the product segment level. Across all product lines, the fiber yields higher inventory values than LIBOR and weighted average method, with no outliers deviating from this overtrend. And this result conclusively demonstrates that the impact of valuation methods on inventory assessment is not product specific, with a fundamentally unified rationale. Differences in cost assumptions only systematically alter the allocation ratio between sold cost and ending inventory cost without affecting the total inventory cost itself. So, based on this analysis, I will propose adjustment plans and outline clear implementation steps to help Wells Water Sports Inc. optimize its inventory counting system. So, while LIBOR indeed enable companies to retain more cash flows by leveraging tax deferred advantage during the past inflation periods, Wells Water Sports Inc.'s current strategic focus has shifted towards global expansion and financing-driven capacity growth, rendering the original valuation rationale obsolete. I recommend transitioning from LIBOR to FIBOR, as the approach better aligns with the company's long-term development objectives. Switching to FIBOR delivers 4 key benefits: optimizing working capital structures and current ratio performance. It also enhancing the financial institution credit limits, obtaining market-aligned inventory turnover figures, complying the international accounting standard requirements, and overcoming the regulatory hurdles for global expansion. And the transition to Wells Water Sports' new accounting framework requires following 4 steps. The first is, the submitting the IRS from 3,115 to a request and accounting policy change, and spreading the tax adjustments accumulates under the LIBOR methods over 4 years, and upgrading the ERP system to support batch checking and cost allocation under the FIBOR model, and providing appliance training for the finance team, and proactively communicating the balance sheet optimization benefits of these changes to stakeholders, including the shareholders and creditors. So the following adjustments, the company's inventory at the reporting period will at the reporting period ends will increase by $1,776, which is significantly enhancing balance sheets reliance and optimizing the liquidity matrix. So That's all of my presentation. Thank you.